Hello, everybody, and welcome to the 2023 year-end planning opportunities presented by Dechtman Wealth Management. We are so excited that you took time to learn about all the opportunities and strategies that we're going to talk about today. The program itself is approximately 40 minutes, plus or minus. As always, we allow time for Q&A at the end of the presentation and would encourage you to ask questions. Please type your questions in the Q&A box. You'll see the icon box at the bottom of the screen. Just type that in and we will address that during our discussion at the end. As usual, we have important disclosure information on page 1 and page 2. The presentation is recorded. We will be sending a replay to you, hopefully by the end of next week. And how we're going to present today's program is I'm going to kind of kick things off, and then Sam is going to lead us through the discussion. I will then come back to tie things up and take Q&A. So we have a packed session here. I would encourage you to grab a pen and paper, make some notes. You don't want to miss some of the strategies that we're going to be addressing. We're going to cover areas to begin, such as the Secure Act 2.0 and tax strategies that would go along with that. Next will be inflation and the economy, followed by interest rates and what to expect going forward, investment opportunities, and then we tie it together with important annual reminders. So on that note, let me turn this over to Sam and let's get going.
All right. Thank you, Jordan, for that introduction. Let's begin by talking about the Secure Act 2.0 and tax strategies. Now, before we jump in, what is the Secure Act 2.0? You could say it's the sequel to a major retirement bill that was passed a couple of years ago. And so the Secure Act 2.0, as it's being called, was passed at the end of 2022, and some of those changes took place in 2023. But there were a lot of other changes that are going to be implemented in future years. So we're going to first talk about what applies at this moment, and then we'll, at the end of this particular section, we'll talk about future changes that we want to put on your radar. Because even though they may not be applicable today, it's important to think about them in advance so we can plan and really best optimize your situation to take advantage of that. Now, one item that has gone into effect is the change in RMD ages. Now, RMD stands for Required Minimum Distribution. So once you reach a particular age, and you could see which age applies to you based on when you were born, the government requires that you take a little piece out of your pre-tax retirement accounts. So this could be a 401k, 403b, 457, traditional IRA, those types of accounts. You had put the money into those accounts and it was before tax. They grew tax deferred. And then once you reach this particular age and have to pull money out, it's going to be fully taxable. So for all folks that were born between 1951 and 1959, the age upon which you must start taking from these accounts is 73. From 1960 or later, your RMD age is 75. Now, the fact that these ages were pushed back is only going to be a benefit to everyone. This is just the age that you're required to take it out, not the age that you are able to take it out. So if you need funds, of course, you can still do it. But this is just saying you don't have to unnecessarily take it from these accounts and ultimately be taxed for it. So I wanted to make everyone aware that this has changed, and depending on when you were born, the ages are different. Now, some tax strategies that are important, not only this year, but ultimately every year, we wanted to put in a list in terms of ones that we think are most applicable to the majority of the folks on the call. The top one is really maxing out your retirement plans. So your retirement plan might be a 401k. simple IRA, SEP IRA, or a traditional IRA or a Roth IRA. And there's a whole host of other ones that we didn't mention. When you max out a retirement account, it's a great way to not only help you build up your nest egg, but also potentially, if it's a pre-tax account, which most of them are, except for the Roth IRA, you're able to get that tax deduction. And often the way the tax code works is that when you get a tax deduction and you lower your AGI or your taxable income, it also impacts different tax brackets in many different areas. So not only your salary, but it might also impact the tax bracket when it comes to long-term capital gains. So figuring out a way to lower your AGI or taxable income is crucial. Another strategy that we're doing on your behalf is tax loss harvesting, but wanted to just bring it to the forefront so you know what we are doing. When you sell an investment and it had made money, you realize a gain. Now, the only time there's a taxable event when you realize a gain is when it is in a non-retirement account. But tax loss harvesting means that you can cancel out gains with losses. So if something in the investment account is down, you can actually sell it and realize a loss, and it actually cancels out versus a gain. So we're looking for different opportunities, particularly as we get close to year end, where we can cancel out some gains with some losses to try and minimize taxes. But of course, the overall goal is, making sure that we're moving the account forward in the right direction. Another strategy is a Roth IRA conversion. Now, this does not make sense for everybody, so we will absolutely need to talk about your particular situation to see if it makes sense. But what is a Roth IRA conversion? A Roth IRA conversion is where you take a piece of a traditional IRA and you move it into a Roth IRA. When you take the money from a traditional IRA and move it to a Roth, every cent that is taken out and transferred is fully taxable. So why would we even consider doing this? Once the money is in a Roth IRA, you are over 59 and a half, and the account's been open for at least 5 years, all of the money comes out tax-free. So having the Roth IRA and adding to it and letting it grow and build, tax-free for your intended or for your entire retirement is an incredible benefit, and one that is really a great source of cash given later in your life if you have bigger expenditure, whether it be healthcare or otherwise. Now, Roth IRA conversions aren't always simple, and it's not, in most cases, black or white in terms of, what is absolutely going to be the best strategy. For example, a Roth IRA conversion is most beneficial when we know with pretty darn good certainty that your tax rate in the future is going to be higher than it is today. That way we could take advantage of paying lower taxes now as opposed to paying them higher later. And so we'll need to, of course, talk about your situation before we want to do that. Another strategy is called a QCD, or a qualified charitable distribution. Now, this one is particularly important for those clients that are charitably inclined. And so the way that this works is, let's say that you have a traditional IRA and you donate to charity. So if we didn't do this, what we would do is we would take a distribution from a traditional IRA, it would be fully taxable, and then you would write a check to the charity. Now, if you're using the standard deduction, which most folks do, you get no tax benefit when you write that check to a charity. However, with a QCD, instead, we can direct money from your IRA directly to the charity. And so when the money goes from your IRA directly to the charity, none of that is taxable. So that way you're paying less in taxes, and you also have the ability to donate even more to your favorite charitable cause. This and this alone is probably the best strategy for those who are charitably inclined. And it applies to anyone that is over 70 and a half. Now, the last one is contributing to an HSA, or health savings account. If you are on Medicare, you can no longer contribute to an HSA. So this applies to everyone who is not on Medicare. Now, an HSA is one of the rare, we like to call triple threats in the tax code, if you will. Your contribution is tax deductible, the money grows tax deferred, and when you pull it out for a qualified medical expense, it comes out tax-free. So if you have the ability to contribute to an HSA, we find that it's a great strategy to have the money continue to, grow, because sadly, all of us are going to need, some money at some point in time for, health expenses. Now, one of the biggest changes that occurred in the Secure Act 2.0 was the way that they handled inherited retirement accounts. So we listed examples of some retirement accounts being a 401k, 403b, IRA, Roth IRA, etc. Now, for non-spouse beneficiaries, they are now subject to a 10-year rule for inherited retirement accounts if the original owner died after 2020. So everybody from this point forward is subject to this. So if you are a non-spouse beneficiary, you have 10 years to take the entire balance of the account. At this moment, there is no requirement to do any annual RMDs. However, that might be subject to change based on future guidance from the IRS. But at this moment, nothing to do on a yearly basis, but in 10 years, everything must be taken out. So if you're going to be inheriting a retirement account or have inherited a pre-tax retirement account with substantial assets, it's going to be very important to make sure that we're taking little bits and pieces throughout the years. That way we don't have one big year where, we're pushed up 1, 2, maybe even 3 tax brackets where we could otherwise avoid it by stretching that out. And so something else that I should have mentioned on the, previous slide in regards to the Roth IRA conversions, but also applies here, is that there was another large tax law that was passed that went into effect in 2017. And so those effectively lowered all of the income tax brackets. However, the income tax brackets are going to revert back to those higher levels beginning in 2026. And so it'll be important to understand that if Congress does nothing, it will automatically go back up to higher income tax rates. And so if we can take advantage of distributions 2023, 2024, 2025, that would be a great thing. Now, there are some folks who are not subject to this 10-year rule when it comes to inherited retirement accounts. And those exceptions apply to minor children, disabled persons, those that are chronically ill, spouses, certain trusts, and another one, which is slightly confusing the way it's written, is anyone not more than 10 years younger than the original owner. So if your sibling passed and they were 9 years older than you, so you are 9 years younger, you would apply for one of these exceptions. If your sibling was younger than you, then you would apply for one of these exceptions. It's anyone who is not more than 10 years younger, which, does not ultimately apply. But if you have any questions in regards to if or not any of these exceptions apply to you, please reach out to us and we'll help you get that sorted. Now, here's a list of some upcoming tax changes that we want to put on your radar. Again, not incredibly important to be well-versed in all of these, but please call us or email or set up a meeting if you want to learn more. The top one is the new post-death option for surviving spouses beginning next year. So if you happen to be in that particular situation next year, we just want to let you know now that you have more options, that you're going to have more options available than you currently do. So we want to help you talk through what each of those might be to help plan most effectively. The second item, and this is one, I just spent a moment talking about, is that income tax brackets will revert back to higher levels beginning in 2026. So this is important when it comes to inherited retirement accounts. This is important when it comes to Roth IRA conversions, as well as how we also want to be saving effectively, and which accounts we want to put money in. The third one is the estate tax exclusion will also revert back to lower levels beginning in 2026. It won't apply to most folks, but there are certainly a handful on this call that it will apply to. So this is another reminder to make sure that you have an estate plan that's updated and everything fits the way you want it to. The fourth bullet point here is 529 to Roth IRA transfers. Now that'll begin next year. So if you have money that's left over in a 529 that you're no longer going to use for educational purposes, for children, grandchildren, etc., you now may have a solution on how you can get those funds out of the 529 without a penalty. And there's about 6 different boxes that you have to check in order to do this. So if there is money left over, call us. We'll walk through each of them and how we can best put this in motion. Now, the last one, this doesn't go into effect till 2025, but another one of those things we wanted to put on your radar. So only participants turning 60, 61, 62, or 63 during the year will have increased contributions to their 401k plans. Now, once you're over age 50, you are entitled to a catch-up limit. But these folks will have not only the catch-up limit, but an additional amount that they'll be able to contribute. Now, you might be asking, why does it only apply to these 4 ages? I don't think anyone really knows the answer to that question, but that's how the law was written. And so we'll help you be able to say even more if you are one of those ages, beginning in 2025. Other updates that apply to most folks here is regards to Social Security and Medicare. Social Security recently announced that their COLA, or cost of living adjustments, for 2024 is going to be 3.2%. So everyone who is currently receiving benefits will see that automatically reflected. Now, a large benefit of the COLA as well is that anyone who's over age 62, regardless of if you're receiving benefits or not, will see an increase in your future expected benefit if you're not receiving it, or your currently received benefit as well. Now we also see the chart here for Medicare Part B premiums, and you can see that all of the different brackets had gone up. Now, something that's important to be mindful of is it's looking at your 2022 income to assess what your Medicare premium is going to be in 2024. Medicare does what's called a 2-year look back. So you can see where you fit. And yes, these numbers are monthly and they are per person. Now let's spend a moment talking about inflation and the economy. So after nearly 2 years, inflation has finally started to embark upon a sustained downtrend. We had peaked at 9.1% last June, to where the last number we got was 3.7% in September. And similarly, core inflation has also continued on a downtrend after the last 11 months in terms of when that peaked. And many of the areas that had driven inflation and subsequently have started to come down have started to stall. So we haven't seen inflation decrease as exponentially as we've seen in the past over the last couple of months. In particular, a spike in energy has caused inflation to jump a little bit. However, easing vehicle prices, have been a big source of disinflation. So while the inflation rate is higher than the Fed's 2% target, we believe that possibly by the end of the year, we might be at 3%, with, we believe, a path that by the end of 2024, we could be a heck of a lot closer to 2%. But we wanted to show you this chart to give you an idea in terms of what headline and core CPI have looked like going all the way back to the 70s. And then we also calculated the 50-year average as well. And so you can see that we're not too high above or not too different from where we've been on the 50-year average. But again, the goal is 2%, and that makes everybody better off when we're a lot closer to that number. Now, in regards to the economy, in the third quarter, inflation coming down, as well as stronger growth, helped fuel optimism for a soft landing. Now, a soft landing means inflation comes down without a recession. However, monthly data suggests that the momentum is slowing and we may not be out of the woods quite yet. Business spending has been a little bit stronger, but it appears that, the consumer, while they've been spending more, has really been depleting their savings and starting to take on a little bit more debt. So we are seeing delinquencies starting to rise a little bit, which is something we're paying very close attention to. Now, when it comes to monetary policy, it lags greatly. a decision isn't made and then we don't see the immediate effect take place in the market. There is a long period of time between when a decision is made and when you actually start to see that reverberate. And so, along with the higher energy prices and forthcoming resumption of student loan payments, we believe that this is going to weigh a little bit more on consumer spending in the months ahead. Overall, though, we think that the U.S. economy should continue to grow at a moderate but slowing pace from here. And so while a near-term recession is not guaranteed, we do think that a slower moving economy will make stocks a little bit more sensitive. Now, on this chart in particular, we wanted to show you what job openings look like, because this is one of the key indicators that we're really paying most attention to in terms of, okay, could this be that canary in the coal mine, or could this really be the first indicator on the flip starting to be switched? So what we're looking at here is job openings that go back to 1973. And we can see that in March 2022 reached an all-time peak of 12 million job openings, which is absolutely incredible. And that number has come down pretty precipitously to where we're at 8.8 million. Now, the 8.8 million is still a very, very large number of jobs that are available for those that are seeking it. But it's very important to see just how quickly that has come down. And so we'll be paying very close attention to how many employers are no longer listing jobs. And maybe that'll help give us a leading indicator on when we're going to start to see the economy at large go from adding jobs on a net basis to actually layoffs on a basis. And we think once folks start losing their job, which I think is sadly one of the goals of the Federal Reserve to tackle inflation, then we think the economy might be in a little bit rougher waters at that point. Now, in regards to interest rates, the Federal Reserve has increased interest rates by a cumulative 5.25% over the last 18 months, again, trying to battle inflation. So right now, the federal funds rate is between 5.25% and 5.5%. And while this had been largely telegraphed, it still caught folks a little bit off guard because it was very different from what the market had expected when we began the year. The Federal Reserve has come out pretty conclusively and said that they expect one more rate increase by the end of this year, and they are only forecasting 2 cuts by the end of next year. And the reason for this is they have a much more optimistic outlook in terms of what the economy is ultimately going to look like and the economy's resilience through all these headwinds. The Federal Reserve does not want to cut interest rates too fast and spur inflation again. And so if we have a soft landing or a mild type of a recession, you may see the Federal Reserve start to inch interest rates back down by the end of next year, or potentially 2025. But if we have something that's a little bit more steep or dramatic, you might see them cut interest rates more specifically. But in terms of this particular chart, this gray bar that we're seeing, that is what the actual Fed funds rate has done over time. The blue line tells you what the Federal Open Market Committee, the FOMC, has in terms of their year-end estimates. So let's just look at that one first. We can see that the expectation is it's higher by the end of 2023. And then as we go to 2024, 2025 and beyond, they expect it to be lower. And then the green line tells you what the market expectations are. So the market isn't too far off in terms of what they expect versus what the Federal Reserve is forecasting. So this is going to be one of those big indicators in terms of how the Federal Reserve reacts and ultimately the way the economy reacts that we're going to be paying very close attention to, and we think will really dictate what the future short-term returns ultimately might end up looking like. We're going to talk about investment opportunities, but before we do, we wanted to just talk about some current events because we get a lot of questions about it. And it's in regards to the war that's currently going on in Israel. On October 7th, Israel was attacked by the terrorist group Hamas, and Israel has in return begun to defend its country and is trying to ultimately eliminate Hamas. And I just want to be very clear that, we stand with Israel, and it's very sad. And, we don't want this to extend to a greater war. But the question we get all the time is, what if this does extend to a greater war? What does that ultimately look like for us from a stock market standpoint? Is this going to have wider implications? So we wanted to show this chart, and there's a couple key things that we want to point out. One is, sadly, you can see how many different data points there are on here going back almost 100 years. Sadly, as humans, it seems like we are in a constant state of war, at least in one part of the world. But the trend is very important to see, that even in spite of all of these wars, the stock market still finds a way to continue moving forward. So even if you're looking at a particular data point on this chart and seeing that the market went down after the fact, it's very important to acknowledge that just because a war happened and the stock market went down does not mean that the war had caused that. There are a multitude of different factors that are always going on at the same period of time. But if we look at the United States and the wars that the United States is, particularly involved in, generally we find that over the course of a war, that the stock market is actually positive. So maybe contrary to what would be expected, because war is such a sad thing, it does not necessarily spell a bad thing when it comes to the stock market. Now, wanted to show you this chart as well because we found it very interesting. And this tells you what the average stock market return is by month. And so we can see that September, the only stock market month that on average is down, was unfortunately down as well this year. But if history, is any sort of trend, that might mean that we could have a positive bounce back, by the end of the year. So just wanted to show this to everybody, saying that just because September's bad, which it normally is, does not necessarily mean that we can't have a strong finish. Now, we spent a lot of time earlier talking about inflation rates, and we're also going to talk about interest rates here in a moment. But is having a high inflation rate bad for the stock market? Is having a lower inflation rate better? How does this actually look? So we went back and we ran the numbers going all the way back to 1926. And we wanted to see, okay, when we began at a particular interest rate, how did the stock market perform over the next 1 year, 5 year, 10 year, and 20-year time periods? So right now, the inflation rate, depending on if you're doing core CPI or headline CPI, we'll just use this 2 to 4% bucket here. So we could see on average over the next 1, 5, 10, and 20-year time frame that the stock market is still positive. And there's a couple key things that are important to understand, not only from this chart, but in general. The stock market is the best hedge against inflation amongst any other types of investments, bar none. Stocks have been the only proven investment that continually beats inflation over time, even when you have very high inflationary periods. The reason for that is because when inflation is high, companies ultimately pass along the cost of higher goods onto consumers. And when companies charge more for particular products, that means that they're making more in terms of revenue, and potentially that translates into profits as well, which are then given to shareholders. So just because inflation is high does not necessarily mean bad things in terms of future stock market returns, even though on the personal side, we want to see inflation keep in check. Now with interest rates as well, is having a high interest rate bad in terms of the stock market, and what does that performance look like? So in terms of the interest rate we're looking at right now, we're in this 4 to 6% bucket, 5.25%, as we talked about earlier. So again, we can see over the 1, 5, 10, and 20-year time frame, having a higher inflation rate does not necessarily spell bad future returns in terms of the stock market. So just wanted to show these charts and again illustrate, while we want inflation to be down, while interest rates may come back down at some point in the future, if they are to remain at their current rates, it still gives us a runway for success. And this is another chart that we think is very appropriate to share, particularly after a tough 2022. So what we're looking at here is calendar year returns for the S&P 500 in those thick blue bars. The orange bars beneath are the intra-year declines. So what that means is over a given year, how much did the particular market go down? And so you can see a couple things from this chart. One, most years the stock market is positive, and it is very positive. And you can also see, even when it is positive, that there are still big corrections, still big pullbacks, and in some cases, bear markets that occur over the course of the year. But it doesn't necessarily mean that when you get to the end of the year, that it ends up being poor in terms of performance. So over this time period, intra-year declines are just about 15%, but the average end of the year return is about 10%. So again, even though we have volatility, that does not mean that the stock market, is ultimately going to have a bad year. Now, where can we take advantage of different opportunities outside of the stock market? One is in what's called a United States Treasury bill. We have been beating the table on this for the past year or so, and will continue to do so as long as interest rates, as long as we're getting paid this type of an amount. So why do we love T-bills? And we call them T-bills as the nickname. They're backed by the full faith and credit of the United States government. So putting it a different way, if you hold a T-bill till its maturity, you are guaranteed a positive rate of return by the United States government. Second, they're a fixed interest rate. So once you buy a T-bill, you are locked into that particular interest rate. So it can't go down while prior to it maturing. The next is that they're very tax advantageous. So the interest on a treasury bill is exempt from state and local taxes. So this is very different from a CD. This is different than a money market account. This is different than the savings in your bank account. The savings in a CD in the bank, that's taxed at both the federal, state, and local taxes, whereas a T-bill is taxed at only the federal level. So these interest rates are extremely great and competitive, and you get that little after-tax boost. And then lastly, the money is liquid. And so there is no penalty if you sell before maturity. So if you bought a 12-month CD and you needed the money in 6 months, your bank is going to penalize you about 3 to 4 months interest. But with a T-bill, if you bought it for 12 months and you needed the money in 6 months, you sell and you get whatever the value is on that particular day. The only thing that the maturity tells you with in regards to a T-bill is how long you are locked into that particular interest rate. It does not mean that you have to keep your money there for that entire period of time. So if you have money that's in the bank, if you have money in a CD that's maturing and want to have it remain conservative, this is a fantastic opportunity where you can get, depending on the time frame, roughly 5.5% that is guaranteed by the United States government. So now I'll turn it back over to Jordan to talk about some important annual reminders.
Okay, Sam, thank you. As always, we want to strongly encourage you to schedule a review consultation. We are never too busy to help. We can meet in person at the office. We can schedule a Zoom call or even a phone call. So very important that we do check in and check up and make sure you're on the right track. Something that we talk about all the time is reviewing beneficiaries. A lot of people make the assumption that everything is all well and fine, but it's always good to do a double check and make sure that your intent is exactly the way everything is set up. You would be surprised that there's a lot of assumptions and people think that what is supposed to happen may not be exactly the way they had set it up. The next item is, as Sam touched on, and we really want to emphasize this, is that income tax brackets will revert back to the higher levels beginning in 2026. So in 2016, there was a tax law that went into effect, and if Congress does nothing, tax rates are going up. So we have a planning opportunity here in 23, 24, 25 to do some good work and to get ahead of that. The next item, distributions from inherited retirement accounts, another items Sam mentioned. It may be an opportunity to start those distributions sooner than later. And we want to make sure that that's being looked at as well. Roth IRA conversions, great planning strategy. We absolutely love it. However, it's not for everyone. First off, we want to make sure that it makes good economic sense and that we're very sensitive and cognizant of your tax impact. So that's something when you do talk to us, you come in and meet with us, or we talk over the phone, that's something that we will run an analysis and make our recommendation. With regard to QCDs, the qualified charitable distribution, again, something Sam touched on. We think this is a great strategy for those that are charitably inclined. If you're over the age of 70 and a half, you have access to this planning strategy. We can go over the what fors and the what twos and the hows and all that, but please let us know sooner than later. At the very, very latest, we ask to do it on or before December 10th and hopefully before that. Medicare and open enrollment runs through December 7th. So those of you that are under Medicare, there is a great planning opportunity for you to double check that you can perhaps improve on your plan or maybe save some money. In-house, Dechtman Wealth Management can help you with that. All you have to do is give us a call. And lastly, cybersecurity is becoming such an important thing. There's a lot of bad actors out there who are disguising themselves through emails. And unfortunately, they do get through to some folks. So if you need help and have some questions with cybersecurity, please let us know how we can help you. We've taken extra measures here at our firm. And if we ask you additional security questions when you do call in, please understand it's for your benefit, safety, and protection. On that note, we would like to ask you to type in your questions in the Q&A box at the bottom of the screen. We already have a few questions, so I'm going to jump right in, but please jot those questions down. And I apologize in advance if I don't get to everyone's question. We have a ton of questions, and I'm going to do the very best I can. Our first question is there an age limitation on Roth IRA conversions? Great question. There is no age limitation on Roth conversions. Even though you might be taking RMD, you can actually do a Roth conversion in addition to. As I'd mentioned, we want to look at the numbers to see if it makes good economic sense, and we can definitely give you advice and guidance on that. Okay, we have another question with regard to T-bills. So the question is twofold. It looks like it's a two-part. First of all, how do you buy T-bills? I'm glad you asked that. That can be purchased through our firm, Dechtman Wealth Management, and we would do that on your behalf. So that's part one. And part two is, when do you cash in the T-bill at the end of the maturity? In other words, what do you do? Well, when the T-bill matures, assuming it's held to the end of maturity, we then can repurchase another T-bill or look at other options. So lots of flexibility, lots of options. And as Sam mentioned, even between the time you purchase a T-bill to the time it matures, it's still available and still liquid. Okay, great questions. Keep them coming. Another question is with regard to Social Security. I'm looking at Social Security and my options. What's the best route in terms of deciding what to do and when to do that? Um, love that question. Again, we can help you. Let us know, give us a call, and we can talk more about that. Okay. Boop bop beep bop bee. Sam, anything else?
I think I see a question here about gold and silver. And so I'll answer that one. So gold and silver can be pretty when it comes to jewelry. When we view them as an investment opportunity, it's not something that we think is a great idea. The reason why you're seeing them likely on TV or it's being fed to you based on the internet is they're largely going after folks and selling it in terms of fear. No one sells gold when they're telling you that the world looks great. They're selling you on gold and silver because they're trying to convince you that the world is coming to an end, and the only way you can protect what you have is to go into gold and silver. But ultimately, gold and silver are like any other commodity. They don't pay dividends. It doesn't earn interest. There's no cash flow when it comes to gold or silver. Like any other commodity, it's only as valuable as someone thinks it's going to be tomorrow. And so when we look at how that compares to stocks, bonds, or really conservative bonds such as T-bills, we think there's a lot better the opportunities out there.
Okay, thank you, Sam. So at this point, we want to say thank you to everybody. We would encourage you to schedule your review consultation. Next slide. And call the office. You can certainly send us an email. We are here for you, happy to help always. And we thank you very much for your time. Have a wonderful day.
Thank you.
Thank you.